Welcome to this special audiobook session, and thank you for being here. Before we start, take a breath and settle into a comfortable space, because what you're about to hear is not just a breakdown of trading psychology, it's a reset for your entire mindset as a trader. Whether you're a beginner, an intermediate trader, or someone already deep into the markets, this journey is going to reshape the way you look at your patterns, your habits, and the silent battles happening in your mind every time you click that buy or sell button. This audiobook is inspired by the mental game of trading, but everything you hear is expressed in my own style, in my own words, completely original and designed for a YouTube-safe listening experience. So let's begin. Most traders think they have a strategy problem. They think they need a better entry, a better indicator, a better risk-reward setup, or a better signal that magically filters out all losing trades. But the truth is, most traders don't fail because their strategy is weak. They fail because their emotional control is weak. The market doesn't test your strategy. It tests your patience, your discipline, your ability to stay logical when money is on the line, and your capacity to remain stable while watching candles move against you. Trading is not a game of charts. It's a game of the mind. Every trader eventually discovers that strategies are easy to learn, but emotions are incredibly hard to master. You can read books, watch tutorials, buy courses, and still repeat the same mistakes. You still enter too early, exit too soon, take trades you promised you'd avoid, break your rules, chase random moves, and revenge trade after a loss. And you do all this knowing that it's wrong. That's how powerful emotions are. They don't need your permission to take control. Fear and greed are not just words. They are forces. Fear shows up in many ways. Fear of losing money, fear of missing a move, fear of being wrong, fear of your setup failing again. And greed shows up as overconfidence, oversized position sizes, unnecessary risk, and a desperate urge to make it all back in one single trade. Together, fear and greed create a mental hurricane inside the trader's mind, and that mental storm destroys more accounts than bad strategies ever will. When you look at a chart without money on the line, everything looks simple. You can see the trend clearly. You can spot the structure. You can identify where you would have entered and where you would have exited. You can even explain the entire move like you're teaching someone else. But the moment you put real money into a live trade, everything changes. Suddenly, every tick feels personal. Every pullback feels dangerous. Every candle feels like a threat. And your mind becomes noisy. You start hearing your own thoughts racing faster than the market itself. This is where psychology takes over. You might have noticed something strange about trading. When you're in profit, you become nervous. When you're in loss, you become hopeful. Logically, it should be the opposite. Profit should feel good. Losses should feel scary. But the trading mind works differently. The moment you see green on your screen, you fear losing it, so you close early. The moment you see red, you tell yourself it will come back, and you hold longer than you should. This emotional inversion is one of the biggest reasons traders struggle. Your brain is wired for survival, not for probabilities. To succeed as a trader, you must rewire how your mind reacts to uncertainty. And uncertainty is the heart of trading. No matter how strong your setup is, no matter how perfectly you've analyzed a trend, there's always uncertainty. The market can change direction without warning. A candle can reverse instantly. A clean trend can suddenly break down. Professionals understand this uncertainty deeply, and they accept it. They do not try to control the market. They only control themselves. But most traders try to control the market emotionally. They move stop losses. They add to losing trades. They close winners too early, and they constantly switch strategies. All attempts to create certainty where none exists. The real mastery in trading is not predicting what the market will do, but controlling what you will do when the market does something unexpected. Every trader also has what psychologists call mental leaks. These are emotional blind spots, small behaviors that seem harmless but gradually erode your consistency. You may hesitate to enter a perfect setup because of one bad memory. You may push too hard after a winning streak because you feel invincible. You may refuse to exit a losing trade because accepting a loss feels like accepting personal failure. These leaks drain your discipline slowly over time until your confidence collapses. To fix these issues, you must develop emotional awareness. This means watching your mind the same way you watch charts. What thoughts show up when you're in profit? What emotions rise when you're in loss? Do you feel panic? Do you feel frustration? Do you feel excitement? Which emotions push you into impulsive behavior? Self-awareness is the beginning of psychological mastery. And here's something important. Your emotions are not random. Behind every trading mistake, there's a reason. Fear comes from past pain. Overconfidence comes from past success. Hesitation comes from past trauma. And FOMO comes from the deep desire to not be left behind. Understanding these roots is how you begin to correct them. The goal is not to kill your emotions. The goal is to manage them. Professional traders have routines not because routines are fancy, but because routines protect them from emotional chaos. They prepare before the market opens. They review their mistakes. They set limits. They follow a process. And most importantly, they don't allow the heat of the moment to rewrite their plans. They respect the rules even when their emotions scream at them to break them. This is what separates consistent traders from impulsive ones. Most beginners think discipline is something you magically develop, but discipline is not motivation, it's repetition. You become disciplined the moment you commit to your rules, even when it feels uncomfortable. Growth happens outside your comfort zone, and in trading, the comfort zone is a destroyer of dreams. If you ever wonder why you make the same mistakes repeatedly, it's because unresolved emotions keep repeating themselves. The market triggers the same fear, the same greed, the same insecurity, the same frustration, until you finally address it. You can't trade your way out of emotional issues. You must understand them, process them, and correct them consciously. So as we move forward in this audiobook, I want you to remember one key idea. The market is not your enemy and it's not your friend. The market is neutral. The real struggle is between you and yourself. Master yourself, and the market becomes easier. Fail to master your mind, and even the simplest strategy will break under pressure. As we move deeper into the mental side of trading, it's important to understand that emotional control is not about suppressing your feelings. Suppression is dangerous. When you try to force your emotions down, they build pressure inside you. Eventually, that pressure erupts at the worst possible time, usually right in the middle of a trade. Real trading psychology is about acknowledgement, not avoidance. You need to recognize what you're feeling, understand why that feeling is showing up, and then make decisions based on logic instead of impulse. One of the most common emotional patterns among traders is the cycle of hope and denial. It usually begins when a trade goes against you. At first, you tell yourself it's just a pullback. Then the pullback turns into a deeper drop. Your stop loss is near, but instead of closing, your mind starts negotiating with you. You say things like, "It'll come back," or "Let me give a little more room," or "The market is just shaking people out." These small justifications feel harmless in the moment, but they create a psychological trap. The trap is denial, and denial is one of the most destructive forces in trading. Denial blinds you to real information. It makes you ignore risk. It turns a small, manageable loss into a catastrophic one. When denial takes over, you stop trading the market and start trading your imagination. You hold on not because the chart says so, but because your emotions are afraid of accepting the truth. This emotional resistance is the reason many traders blow up accounts even when they have a good winning rate. One huge denial-filled mistake wipes out months of discipline. On the opposite side of denial is overconfidence. Overconfidence is equally dangerous, but much harder to detect because it disguises itself as strength. When you have a winning streak, your mind naturally feels rewarded. You begin to believe you're seeing the market more clearly than others. You raise your position size. You take low-quality setups because you feel invincible. You break your rules because in your mind, you've figured it out. But the market punishes overconfidence with no mercy. One or two bad trades taken with oversized positions can erase the entire winning streak and leave you mentally shattered. The transition from confidence to overconfidence is subtle, and that's why many traders don't see the turning point until it's too late. The key is understanding that confidence is earned, but overconfidence is assumed. Confidence comes from discipline, consistency, review, and steady improvement. Overconfidence comes from the ego trying to take credit for what might have been luck, volatility, or temporary market conditions. Another mental challenge in trading is impatience. Today's digital world has conditioned us to expect rewards instantly. We watch short videos, binge content at high speed, and receive notifications every few minutes. This fast-paced lifestyle rewires the brain, making patience feel like suffering. When traders sit in front of the chart, They expect movement. They expect action. They expect the market to give them something right now. But the market does not move on your schedule. Sometimes the best trade of the day forms only once. Sometimes not at all. And yet, traders force entry simply because they cannot sit still. They chase setups that don't exist. They trade out of boredom. And boredom trading is one of the most expensive habits a trader can develop. Patience is not just waiting. Patience is the ability to not act when you feel the urge to act without reason. True patience is active discipline, not passive waiting. It's the decision to stay calm and wait for your setup, even when your entire body is telling you to click buy or sell just to feel the thrill of being in a trade. Most traders lose not because they lack skill, but because they lack the mental endurance to sit quietly while waiting for quality. Another important psychological aspect is attachment. Traders often become emotionally attached to their trades, their analysis, or even the direction they predicted. Once they form an opinion, they cling to it like identity. If they think the market should go up, they see every bounce as confirmation and ignore every signal of weakness. They search for evidence that supports their bias and ignore everything that contradicts it. This attachment creates tunnel vision. You only see what you want to see. And when the market doesn't behave according to your belief, frustration builds. You either hold on to your position stubbornly or flip it impulsively out of anger. Both reactions come from emotional attachment. A professional trader has no attachment to predictions. They may analyze, plan, and prepare, but they don't marry their bias. Their opinion changes as the market changes. They flow with the price. They react to what is happening, not what they want to happen. In trading, flexibility is a skill, not a weakness. The market rewards humility and destroys stubbornness. Another deeply rooted issue is self-sabotage. It sounds harsh, but many traders unconsciously sabotage their own success. They take low-quality trades right after a win. They jump into revenge trades after a loss. They break their rules even when they know better. These actions are not mistakes. They are emotional patterns driven by internal beliefs. Some traders don't believe they deserve success. Some are uncomfortable holding winners because they're afraid of losing what they've gained. Some are addicted to chaos because chaos gives them a sense of excitement that a calm, disciplined approach does not. These traders don't need better strategies. They need to understand themselves. Self-sabotage often reveals unresolved emotional conflicts. For example, someone who has fear of failure may close trades too early to avoid the feeling of being wrong. Someone who grew up with financial insecurity may panic when the market fluctuates. Someone who wants instant validation may chase setups just to feel active. Trading exposes these internal patterns with brutal honesty. Your trading problem is rarely about charts. It's about who you become when money is involved. To overcome emotional challenges, every trader needs a structure. Structure creates safety, and safety reduces emotional volatility. This structure includes a written trading plan, defined criteria for entering and exiting trades, clear risk limits, and rules for when to stop trading, especially on emotional days. Without structure, the market becomes wild and unpredictable, and your mind becomes chaotic. The most powerful traders are not the ones who predict the market best. They are the ones who handle uncertainty best. They understand that they cannot control outcomes, only decisions. They accept that losses are part of the business, not personal failures. They know that every setup has a probability, not a guarantee. And because they accept uncertainty, they no longer fear it. A trader's mind becomes dangerous when it seeks certainty in a world built on probability. The market is a fluid environment. Anything can happen. Anything may reverse. The best trade can fail, and the worst trade can win. Once you embrace this uncertainty, your emotions start losing their grip on you. You stop trying to force the market to behave your way. You start respecting the reality of price action. This mindset shift is what creates consistency. As we continue exploring the deeper layers of the trading mind, we need to talk about something that every trader experiences, but few truly understand: emotional triggers. These triggers are those sudden, powerful reactions that hit you before you even have time to think. They can come from a candle spike, an unexpected reversal, a missed breakout, or even from seeing someone else's profits online. Before you understand what's happening, your heart rate increases, your breathing changes, your thinking narrows, and your body switches into survival mode that has absolutely nothing to do with rational decision-making. The truth is, emotional triggers in trading are not about the market. They're about your past. They're rooted in old experiences, financial stress, fear of loss, failure in other areas of life, or even childhood beliefs about money. When the market hits a trigger, your brain switches from logic to protection. But the market is a terrible place to operate from a protection mindset. Protection causes hesitation, panic exits, and irrational entries. The more you allow triggers to control you, the more unpredictable your trading becomes. The first step to controlling these triggers is recognizing them. Notice the moments when your body tightens. Notice when your breath shortens. Notice when your mind feels cloudy. These physical signs show up before the mistake happens. The body warns you long before your mouse clicks a bad trade. Becoming aware of these early signals gives you the power to pause, breathe, and respond differently. This awareness separates emotional traders from professional ones. Another challenge that deeply affects traders is emotional residue, the psychological leftovers from past trades. You probably felt this. You take a loss in the morning, and even though the trade is closed, the emotional weight lingers. You're not angry at the market anymore. You're angry at yourself. You feel disappointed, frustrated, or ashamed. Then the next trade you take is instantly influenced by that emotional residue. You're either trading cautiously out of fear or aggressively out of revenge. Both extremes are dangerous. Professional traders treat every trade as a completely independent event. They don't let one outcome shape the next decision. If the last trade was a win, they don't raise their risk out of confidence. If the last trade was a loss, they don't lower their standards out of frustration. They reset their mind between trades because they understand the market doesn't care about their past. The market is neutral. Only the trader carries emotional baggage. Let's talk about revenge trading. Revenge trading might be the most damaging behavior a trader can fall into. It happens when you feel wronged by the market, when a loss feels unfair, or when you believe you need to make the money back immediately. In that emotional state, you stop trading your plan and start trading your pain. You take impulsive positions. You ignore your rules. You jump into setups you would never normally touch. Revenge trading is not an attempt to profit. It's an attempt to heal emotional discomfort. The market becomes a punching bag for your frustration, but the market never hits back with mercy. The moment you start trading emotionally, the market becomes a vacuum that pulls your capital away. Every trader eventually learns that revenge trading is a trap that leads to deeper losses, deeper emotional pain, and even stronger desire to fix everything. It becomes a loop of self-destruction. To break that loop, you must learn to pause. Taking time away from the charts after a loss is not a weakness. It's maturity. A reset allows your mind to clear the emotional smoke. It gives you space to think logically again. And sometimes that short pause is all that's needed to prevent one bad trade from turning into an entire downward spiral. Another major psychological barrier for traders is unrealistic expectations. The trading world is filled with highlight reels, screenshots of massive profits, stories of overnight success, and videos promising easy riches. These images create a distorted perception of what trading truly is. They set the expectation that consistent profits should come fast, that big wins are normal, and that success is supposed to be dramatic. But real trading is slow, steady, systematic, sometimes even boring. Professional traders don't aim for excitement. They aim for consistency. They don't chase huge wins. They accumulate small, steady gains. They understand that every trade is just one brick in a larger wall they're building. Unrealistic expectations lead to oversized risk, impulsive decisions, and emotional instability. When reality doesn't match the fantasy, frustration kicks in, and frustration creates bad behavior. To trade successfully, you must lower your expectations and raise your standards. Instead of expecting the market to give you big profits, expect yourself to follow your process. Instead of expecting fast growth, expect disciplined growth. Instead of expecting every trade to be a winner, expect yourself to execute every trade flawlessly. The shift from outcome-based thinking to process-based thinking is what transforms an amateur into a professional. Let's explore another powerful force in trading psychology, identity. Many traders don't realize that their trading results are tied to how they see themselves. If you see yourself as inconsistent, your trading will reflect that inconsistency. If you see yourself as unlucky, you will unconsciously look for confirmation of that belief. If you see yourself as someone who almost makes it but never quite succeeds, your behavior will align with that mindset. Identity shapes everything. To grow as a trader, you must evolve your identity. You need to start seeing yourself as someone capable of discipline, patience, and rational decision-making. You must believe you can follow your rules, even when your emotions are screaming. Identity is not about affirmations or motivation. It's built through repeated action. Every time you follow your plan, you strengthen a new identity. Every time you resist an emotional impulse, you prove to yourself that you're becoming stronger. Another layer of psychological strength is emotional detachment. This doesn't mean you stop caring. It means you stop attaching your self-worth to your results. Winning doesn't make you superior, and losing doesn't make you inferior. Trading is a business, not a reflection of your value as a person. The moment you personalize outcomes, you lose objectivity. A detached trader can evaluate setups clearly. A detached trader can accept losses as normal costs. A detached trader can hold winners longer because they're not scared of the emotional consequences. Emotional detachment is one of the greatest superpowers a trader can develop, but it takes time. It comes from understanding that the market is not judging you. It's not rewarding you. It's not punishing you. It's simply moving. You are the only one assigning emotional meaning to those movements. Detachment frees you from that self-created pressure. Another key idea is that emotional stability does not mean you never feel fear. Professionals feel fear too. They feel doubt. They feel uncertainty. But the difference is what they do with that fear. They don't let fear steer the wheel. They don't let panic dictate their decisions. They acknowledge the fear, but they still follow the plan. Courage is not the absence of fear. It's the ability to act correctly despite fear. As we move deeper into psychology of becoming a consistently profitable trader, we need to confront one of the most misunderstood concepts in this entire journey: discipline. Most traders assume discipline means forcing yourself to do the right thing, but discipline is not about force. Real discipline is built on clarity. When you are clear about your rules, your risk, and your purpose, discipline becomes a natural behavior. You no longer fight yourself. You simply follow the structure you created. But when your rules are vague, when your risk is undefined, when your goals are unrealistic, the mind slips into chaos. Chaos is where impulsive decisions live. Chaos is where mistakes multiply. This is why many traders feel like they lose control during trading. It's not a lack of discipline. It's a lack of structure. Traders expect themselves to behave like professionals even though they haven't created a professional framework. You can't act like a surgeon if your tools are scattered across the table. It's the same in trading. A powerful part of trading psychology is understanding your limits. Every trader has a point where emotions start rising. Sometimes it's after a series of losses. Sometimes after a big win. Sometimes after waiting too long for a setup. That emotional edge is your threshold. Once you cross that threshold, your brain switches out strategic thinking and into survival mode. And survival mode has no place in trading. The key is recognizing your personal threshold before you cross it. Maybe for you it's 2 losing trades in a row. Maybe it's a dollar amount. Maybe it's 3 hours of screen time without a break. Find that edge. Respect that edge. Step away when you hit that edge. The market will always be there when you return. Your emotional control won't. Another deeply important concept is emotional momentum. Just like trends form in charts, trends also form in your mind. If you're calm, focused, and centered, that emotional trend carries into your decisions. But if you're irritated, anxious, or tense, that emotional trend will also leak into your trading. One small emotional slip can trigger a cascade of bad behavior. This is why many traders say things like, "I was doing great until one bad trade ruined everything." Or, "After that one mistake, the whole day collapsed." It wasn't a mistake that ruined the day. It was emotional momentum created by that mistake. To stop emotional momentum from snowballing, you need psychological interruption points. Small breaks, breathing, walking away, resetting your mind. Just a few minutes of composure can save you from hours of chaos. Now, let's explore the idea of emotional honesty. Traders lose not because they can't trade, but because they lie to themselves. They justify bad trades. They bend their rules. They blame volatility, brokers, or news events. They avoid reviewing their mistakes because the truth is uncomfortable. But emotional honesty is the only way to grow. When you look at your trading journal and admit, "I didn't follow my plan," or "I took this trade out of boredom," Or, I was afraid to miss out. You're not judging yourself. You're diagnosing the real issue. And diagnosis is the first step to transformation. The reason emotional honesty is so rare is because it requires vulnerability. Traders think vulnerability means weakness, but in reality, vulnerability is clarity. It's the courage to see things as they are, not as you wish them to be. When you stop protecting your ego, your trading finally becomes real. You evolve, you improve, you grow. Another major psychological force is performance pressure. When a trader feels pressure to make money fast, whether because of financial stress, debt, lifestyle goals, or personal expectations, they start trading emotionally. Pressure forces traders to trade too much, risk too much, and expect too much. The ironic thing is that the more desperately you want profits, the farther they move away from you. Professional traders don't feel pressure because they treat trading as a long-term business. They don't need every day to be profitable. They don't expect the market to pay their bills immediately. They prioritize consistency over speed. This mindset removes pressure, and without pressure, logic returns. Calmness returns. Patience returns. When patience returns, profits return too. To eliminate performance pressure, you must shift from "I need to make money today" to "I need to execute well today." Execution is the only thing you control. Outcomes fluctuate. Execution compounds. Another crucial aspect of trading psychology is resilience. The market will test you again and again. It will humble you. It will frustrate you. It will shake your confidence. But resilience is not about bouncing back quickly. It's about bouncing back correctly. Many traders come back from losses by trading harder, taking bigger risks, and forcing the next win. That's not resilience. That's desperation. True resilience is the ability to recover your mindset before you recover your money. It's choosing to restore your discipline, your clarity, your emotional balance, and your patience before you attempt to recover your equity. When you rebuild the mental foundation first, the financial recovery becomes natural and steady. Another powerful topic is the concept of emotional conditioning. Every time you break a rule and still win, you condition your brain to believe that breaking rules is acceptable. Every time you revenge trade and get lucky, you reinforce the belief that revenge works. Every time you oversize and the trade hits profit, you train your mind to link recklessness with reward. This is one of the reasons traders repeat the same mistakes. They accidentally reward themselves for bad behavior. The brain obeys whatever pattern you repeat. And once a pattern becomes automatic, you no longer control it. The pattern controls you. Reprogramming emotional conditioning requires deliberate practice. Following rules even when you don't feel like it. Taking proper stops even when they hurt. Holding winners even when you're tempted to close. Each time you act with discipline, you strengthen the mental pattern of consistency. Over time, consistency becomes natural instead of forced. Finally, we must talk about the psychological gap between knowledge and execution. Almost every trader knows what they should do. Cut losses, let winners run, avoid revenge trades, follow their plan. The problem is not knowledge. The problem is emotional interference. Fear, greed, frustration, boredom, and anxiety disconnect the mind from the plan. The trader knows what to do but doesn't do it. This gap closes only through emotional mastery, not more strategy. As we move into the concluding phase of this audiobook, it becomes clear that mastering the mental game of trading is far less about finding that one perfect strategy and far more about building a durable psychological architecture that can withstand a constantly shifting market environment. By now, you've seen the patterns. Emotional instability leads to tactical mistakes. Tactical mistakes lead to capital damage, and capital damage often leads to an identity crisis. The antidote to this entire cycle is not luck, or insider information, or some mysterious hidden indicator. The antidote is self-awareness, mental discipline, and a deep understanding of your internal performance engine. One of the biggest realizations traders eventually make, often after years of struggle, is that losses do not hurt because of money alone. Losses hurt because of what we think they say about us. A trader who ties his self-worth to his P&L is doomed to psychological instability. Every time the market dips, his confidence dips. Every time the market rises, he inflates again. He becomes a balloon, floating high when inflated, collapsing when deflated. This emotional whiplash makes consistent decision-making almost impossible. in the mental game, the goal is to untie your identity from your outcomes. You are not your wins. You are not your losses. You are the process you follow daily. You are the discipline you maintain when no one is watching. And you are the stability you carry into uncertain moments. One of the deepest psychological errors traders make is assuming that emotional bias disappears with experience. It doesn't. It simply changes form. Early in a trader's journey, fear and confusion dominate. Later, overconfidence and complacency take over. Eventually, expectations start shaping behavior more than reality. Expectations are dangerous because they create imaginary futures in your head. When the market behaves differently from those imagined scenarios, emotional friction appears, and friction becomes frustration. This happens because the trader believed the market owed him something. In the mental game, you must train yourself to replace expectation with adaptability. The market owes you nothing, and the sooner you internalize this truth, the stronger you become. Another major theme in the advanced mental game is the concept of emotional residue, the hidden psychological baggage from your past trades. These residues accumulate quietly, often unnoticed, and start influencing future decisions without your awareness. A big loss from months ago may still be shaping your risk tolerance today. A huge surprise win from weeks ago may still be fueling your overconfidence. Emotional residue is like dust in a room, invisible at first, but eventually thick enough to affect the air you breathe. Clearing emotional residue requires intentional reflection. This means reviewing your decisions, not just your outcomes. It means asking tough questions. Did I follow my edge? Did I size correctly? Did I exit emotionally or logically? Did I avoid the trade out of fear from past pain? Without clearing this residue, you will make future decisions with a distorted filter. A turning point in the mental game is when you start respecting losses, not fearing them, not denying them, but respecting them. Every loss is information. Every loss is a message from the market about your system, your timing, or your emotional state. The worst traders are those who avoid analyzing their losses because they are afraid of facing their own mistakes. The best traders treat losses like data points. They dissect them, categorize them, and calibrate their system accordingly. When you stop seeing a loss as an attack on your identity and start seeing it as raw information, you reach a new psychological tier. At the same time, you must learn to interpret your wins correctly. Wins are not proof that you are unbeatable or gifted. Wins are proof that on that particular day, under those particular conditions, your process aligned with the market. That's all. If you attach too much meaning to winning streaks, you will start taking reckless trades, increasing position sizes, and assuming the market is predictable. Overconfidence is not a sign of strength. It's a sign of mental imbalance disguised as confidence. The goal is stable, humble self-trust, not ego-inflated overconfidence. To maintain this stability, advanced traders rely heavily on emotional checkpoints. These checkpoints act like internal diagnostic tools. Before every trade, they check, am I calm? Am I chasing? Am I avoiding? Am I biased? Is this trade coming from logic or emotion? Emotional checkpoints prevent impulsive damage. Over time, these checkpoints become automatic. Your mind starts catching emotional spikes before they spill into your decisions. Another critical element of the mental game is the ability to take breaks strategically. The market never stops moving, but your mind cannot run at full capacity forever. A burnout mind produces sloppy analysis, weak discipline, and emotional trading. Many traders feel guilty taking breaks because they fear missing out. But here's the truth. Sometimes the best trade of the month is a trade you didn't take. A mental break resets your perception, lowers emotional pressure, and resets your psychological baseline. After a break, you return with clarity rather than fatigue. As you evolve mentally, another layer emerges, detaching from the need to be right. The ego thrives on being right, but profitable traders thrive on being adaptive. They do not marry their biases. They do not chase validation. They do not argue with the facts. They follow the market, even when it contradicts their predictions. When you detach from needing to be right, you unlock the ability to cut losses early, reverse positions quickly, and accept new information with humility. This is one of the highest levels of trading psychology. At an even deeper level, successful traders cultivate something called emotional neutrality. Emotional neutrality does not mean apathy. It means responding to the market without emotional distortion. It means treating a win just like a loss. Information, nothing more. It means never getting too excited, never getting too disappointed. It means operating like a surgeon, focused, precise, calm. Emotional neutrality is rare, but it is the closest thing to a superpower a trader can develop. A powerful way to reach this neutrality is through intentional journaling, not just noting trades, but noting emotional triggers, thought patterns, fear responses, moment of hesitation, and reasons you broke your own rules. Over time, your journal becomes a roadmap of your psychological evolution. It exposes patterns you can't see in real time. It reveals blind spots you never noticed. It makes your improvement measurable. And when your improvement becomes measurable, your growth becomes unstoppable. By the final stage of the mental game, you begin seeing the market differently. You stop searching for certainty and start searching for probability. You stop chasing perfection and start chasing consistency. You stop comparing yourself to others and start competing only with your past self. This is where mastery begins. Mastery is not the absence of emotion. It is a regulation of emotion. It is not the absence of fear. It is the management of fear. It is not the absence of doubt. It is the ability to act despite doubt. You learn to trust your edge. You learn to trust your data. You learn to trust your discipline. And most importantly, you learn to trust yourself, not emotionally, but rationally, through proven behavior patterns. And now, as we wrap up this audiobook, I want to emphasize one final lesson. Trading is not a career for the mentally weak, but it can build extraordinary mental strength if you approach it correctly. The market is a mirror that reflects everything inside you: your patience, your fear, your greed, your self-control. Every trade you take is a psychological performance. Every session is a test of your mental calibration. Every week is an opportunity to sharpen your discipline. If you treat trading as a mental craft, not just a financial one, you will grow in ways you never imagined. And that brings us to the end of this audiobook-style breakdown of the mental game of trading. If you found value in this deep psychological journey, make sure you subscribe to the channel, drop a like, and share your thoughts in the comments. Your engagement helps this channel grow and helps us create more powerful trading psychology content for you. See you in the next episode.